This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
At the start of this chapter, we gave an introduction to the different business reliefs that would be available to individuals that we'd see through this chapter. In our first couple of lectures together, in addition to that introduction, we've seen the one type of relief where we got taxed at a lower rate, a 10% rate, instead of what would otherwise have been a 20% rate. That used in business asset disposal relief, which, as I'll remind you of in a moment's time, used to be known as entrepreneurs relief and also then in investors relief. The next two types of relief that we see are going to be reliefs that defer gains, and the next two chapters are involved with this relief, rollover relief. In essence, as I hope indeed you recall, not that you might, that I hope you do recall, from the beginning of chapter 14.1, we said that rollover relief would be available when a trader running a business disposed of one qualifying business asset, which would principally be a property used within that trade, within that business, and reinvested the sales proceeds in another one. You're an expanding business, you've outgrown your current business premises, you sell and you buy new, larger business premises, and you reinvest the proceeds in those premises. What happens there is, as long as you have reinvested all of the sale proceeds, which is what I've just referred to, then all of the gain arising on the disposal of that first property may be deferred. The nature of the deferral, the meaning of the term rollover, well, that's explained within the next couple of lectures here, indeed very early on in this lecture. The lectures that we're going to use are the lectures from FA 2019. Now, the only differences that we need to be aware of when you look through and you watch these lectures, you will again do it in conjunction with your Finance Act 2020, your current material, is that in the lecture, as we see here, we use the study notes, which of course are the Finance Act 2019 notes there, and they refer to entrepreneurs relief. Entrepreneurs relief. Now, although there's been one basic change in the application of this relief, it is now known as business asset disposal relief, which after the last two lectures, I'd hope you'd be very much aware of. So you're going to find reference in both lectures 14.3 and 14.4. Yeah, it's quite a big subject, so we've got a couple of lectures that deal with rollover relief, where in the lecture I refer to the term, and you'll see it in the FA19 notes that will be on screen. We talk about entrepreneurs relief. Within your current notes and the term that you will use in answer to your questions as per the FA 2020 material is business asset disposal relief. But there are no changes in terms of the rules that apply, the technique that we adopt, hence the ability to use these particular lectures. In the answers to the examples based on this particular subject of rollover relief, examples 4 to 7, in the, again, Finance Act 2019 material that you'll see in the lectures, I again refer to entrepreneurs relief. Again now, that is business asset disposal relief. Now, all we'll discover in terms of those answers, as you'll see here, is it will say that business asset disposal relief would not be available. And that's repeated, that note, in relation to each of these examples on rollover. We know that business asset disposal relief is not available for an ongoing business anyway, where you simply dispose of a business asset that you happen to have used within the trade. You do not get business asset disposal relief. For that relief to apply, you have to be selling either the entire business or an identifiable part of that business, say 1 out of 2 trades that your business undertakes, but it's separately identifiable as a business in its own right. Merely selling an asset used in that business, no, you do not get business asset disposal relief. And all that happens in every one of the examples, we say that in the absence of rollover relief to allow a deferral of the gain, if that gain became chargeable, you're not selling the business, you're selling this individual asset, and that's it. We'll discover that the asset in question, so far as the rules back then in FA19 and now, and as much as they have ever been, the business asset that we'll be looking at is basically a property used within the business, a business property. Sell one, buy one there. Now what we've also got here, I'll just take you back to that. When you do those examples 4 to 7, you'll obviously be following in the FA2020 material that you have in front of you. Well, thankfully, the dates used are the same in that FA2019 material. So there's no difference in terms of the answers, other than, as I said, references to Entrepreneurs Relief, which is now replaced by Business Asset Disposal Relief. So the next 2 lectures, therefore, 14.3 and 14.4, dealing with all aspects that you need to know to do with rollover relief. Enjoy. Well, as we stated at the end of the previous lecture together, the next 2 lectures that we have deal with 2 separate CGT reliefs that are both deferrals. So we have to recognise, again, as is always the case in relation to any relief, whether or not that relief is available. You have to identify, given that disposal of that asset by that particular individual, will that gain that arises be eligible for any relief? You have to be able to identify. That, as we said, will come with practice. But here the relief that we're talking about, this particular and the first of the 2 deferral reliefs, deals with the replacement of business assets. Now, the most likely business asset to be replaced, that is at least a chargeable asset and will be a qualifying business asset for purposes of this relief, is a property. You are dealing clearly with a business asset, so you're dealing with an unincorporated trader. An unincorporated trader doesn't always, of course, buy their own property. They may simply rent a property for use within their trade. But what we're looking at here is an unincorporated trader that has bought his or her own particular business property for use within the trade, and at some future point maybe they've expanded the business and the current business premises aren't big enough, so we need to expand and we need to acquire bigger premises. So what do? We sell the old premises and buy the new business premises there to continue our business for the future. So what will have happened is the sale will have given rise to a chargeable gain. But what are we then going to do with those sale proceeds? The concept here behind this relief, known as rollover relief here, is that we're going to reinvest those proceeds in that bigger and better qualifying business asset, i.e. basically a property there, a business property. So it wouldn't be a very good motivation for businesses to expand their businesses, make them bigger, employ more people, make more profits, pay more taxes there. That is not going to actually be, again, motivating businesses, entrepreneurs to do that. If all we do is say, yeah, that's a chargeable disposal of a chargeable asset, you're a chargeable person, therefore we're going to tax that gain now, and therefore that gain will be taxed and we'll take that money out of the business. If what we're doing is to reinvest the proceeds of one qualifying business asset, usually a business property, in another qualifying business asset, usually a replacement property, though in reality there are different qualifying assets and you don't have to sell a property, buy a property. You sell a qualifying business asset, you buy a qualifying business asset. It doesn't have to be the same type of qualifying business asset. What we'll discover here in our syllabus is that those qualifying business assets that we need to know about are extremely limited. Therefore, the most likely for rollover relief, as we'll come to know it as, is a business property. we sell, we buy. And if we reinvest all the proceeds in that other property, guess what? HMRC will say, yeah, a gain has arisen, but because you've ploughed all that money back, those proceeds back, into another qualifying business asset, we will allow you to defer the gain. If you choose to make this claim, this is down to you to make the claim, then we may defer that gain. And all we've got to look at is the manner of that deferral. So let's have a little look at what our note says here. Right, a gain may be rolled over, hence the term rollover relief here. And what does it mean, i.e. deferred? Where it arises on the disposal of a qualifying business asset. Now, in terms of qualifying assets, we have got to have both the sale of a qualifying business asset and, as we just said, the purchase of another qualifying business asset. And by far the most likely category is property, land and buildings used within the trade. Used within the trade. If we have an investment property, then this relief is not going to be available. It is for trading assets, assets used within the trade. So land and building is the most likely one. And the only other one that we need to be aware of, so far as our syllabus is concerned, is something called fixed plant and machinery. So it's not movable, it's fixed plant and machinery. We might have a crane system in a warehouse that is obviously fixed, and what happens is it will run along in terms of the actual machinery itself is fixed, but it will be able to pick up again boxes from whatever and put them somewhere else there along that particular line. So it's fixed plant and machinery. What we'll discover though is that fixed plant and machinery is likely also to be known by another definition that will also allow for a deferral under the same heading of rollover relief, but the nature of that deferral is just a little bit different. So we'll start our studies here of rollover relief with, shall I call it, pure rollover relief, that no other variations on a theme. We sell a qualifying business asset, a business property, we buy another qualifying business asset, we reinvest all of the proceeds, all of the gain may be deferred by a claim for rollover relief. Now, we've said here, disposal of a qualifying business asset whose sale proceeds are reinvested in another qualifying business asset. Now, I've kept on saying that for all of the gain to be deferred, all of the proceeds must then be reinvested. If we do not reinvest all the proceeds, then we won't be entitled to defer all of the gain. Instead of full rollover relief, we'll have partial rollover relief. But we'll come to that in just a short while. We've seen what the qualifying assets are, and again, for rollover as we'll define it over the next few minutes, it's going to be a property. Sell one, buy one there. The relief itself. The gain, as we've said, is deferred. So the gain is not taxed immediately, but is postponed, it's deferred until the trader, remember, this is a business asset relief that we're talking in terms of, until the trader makes a disposal of the replacement asset without any further replacement. So if what happens, as we'll discover with the calculations in a moment's time, if we originally acquire a business asset, a property to use within the trade, we then sell, reinvest all the proceeds, then all of the gain arising will be deferred until such time as we sell the replacement asset. But guess what happens when we sell it? Again, we expand. We reinvest all of those proceeds. So every time there's a disposal of a qualifying business asset, if we keep reinvesting all of those sales proceeds in yet another qualifying business asset, then the process of deferral continues on, subject to us choosing, as we no doubt would, to make the claim for rollover relief. How does this deferral work? Well, this deferral, this postponement, is achieved by deducting the gain made on the old asset from the cost of the new one. So, if we take the gain on the sale and deduct that gain from the base cost of the newly acquired replacement business asset, the replacement property, then the new one has a lower cost. So when it is sold, using the lower cost to compute its future gain, its gain will be that much bigger. We'll have deferred that gain till that further disposal. But again, as we've said, if when it is sold, we again reinvest all the proceeds in another, then that, albeit bigger gain that has arisen on the disposal, is again deferred. And how does the deferral work? Hence the name. We roll over that gain against the base cost of the newly acquired asset. We deduct this gain from the cost of the newly acquired asset. By making its cost lower, any future gain is made higher, same proceeds, lower cost, and that gain would then become chargeable unless we make a further reinvestment of its proceeds. Now, there's a few more detailed rules that we need to know about here to be able to deal with this, and then of course I'll take you through an example, indeed a number of examples. This bit, we'll come back to it in a short while, looks at, I've said about reinvesting all of the proceeds, that if we don't do that, then we're looking at partial deferral, partial rollover, rather than full rollover. That's what that bit is about, and there's detailed notes on it coming up. I'll come back to that in a moment. The replacement asset must be bought, right, here's a qualifying condition, in the period between 12 months before up to 36 months after the disposal of the old asset. Now then, the replacement asset must be bought within that period 12 months before to 3 years after the disposal of the old asset. There is a 4-year window of opportunity in which to make the reinvestment. And it might sound odd that that 4-year window of opportunity runs from 12 months, 1 year before the disposal, up to 3 years after the disposal. Because you might be thinking, hang on a minute, how can you be reinvesting sale proceeds before you've got those sales proceeds? Well, you think about the asset that we're talking about, a business property used in the trade. So you as an unincorporated trader, what are you going to do when you expand your business? Are you simply going to think, I need a bigger property. Right, I'll sell this property. I will then get all my plant and machinery, fixtures and fittings and put them in a lorry. And then I'll go and find a new property. Of course you won't. What's going to happen is, before the sale of that old property goes through, you will obtain some sort of bridging finance here to have allowed you to buy the replacement property, so you can shift all the plant and machinery, the fixtures and fittings as required, fit them into your new business property, and take them out of the old one. Get it up and running, and then you'll be able to sell the old one. You're not going to have this gap in trading while you move everything out of the old into a newly acquired property there. That's not going to be a particularly good idea for running your business. So it is probably more likely that when you see an exam question, that actually the sale date is after the purchase date. But again, that's not a barrier to the availability of rollover relief, because the period for which the window of opportunity is open for rollover relief to be available, if claimed, is that the replacement, the reinvestment, must occur between 1 year before to 3 years after that disposal date. Okay, again, a rule for you to remember. Rollover relief is available on the sale of an individual asset, so entrepreneur's relief would not normally be available. Remember, we only got entrepreneurs relief on the disposal of the business or an identifiable part of that business. We might run two trades and we're able to dispose of one of the trades while keeping the other trade. So that was a part, a recognisable part of the business. But if all you do, like we're talking about here, you sell a property used within your trade and you place it with another, that gain, if it does become taxable, is not going to be eligible for entrepreneurs relief because you're not selling the business, you are simply selling an asset that you have used within that business. So here, to recognise that fact, as long as we replace the old asset with a new asset, and if we then reinvest all of the sale proceeds, then all of the gain will be deferred through a claim for rollover relief, should we, as we will, choose to make that claim for rollover relief. However, if the whole business is sold and rollover relief is claimed on part of the gains, you probably wouldn't do this. Then any remaining gain could be eligible as long as it qualifies in its own right for entrepreneurs relief. If you've got entrepreneurs relief available, then you are probably going on a disposal of your business to claim entrepreneurs relief and get all the taxable gains taxed now, but taxed at 10%. It is, of course, possible that you are a serial entrepreneur, and what you intend to do is, having sold off one business and crystallise the gains on it, some of the proceeds that have been generated from that are going to be reinvested in another business. So there might be a property which is a part of the overall trade being sold, and you are then going to take all of your proceeds, some part of which is attributable to the property, and start another business. And therefore you could claim rollover if the amount that you buy your new property for your new business is at least covering the sales proceeds of the old one. So rather being taxed on that part of the gain now at 10%, you could defer it because you know that the property that you bought will be a qualifying property within a qualifying trade, such that when you've built that business up and you sell it, those gains, including that bigger property gain, would be eligible for entrepreneurs relief. So if you've got a choice between being taxed now at 10% or later at 10%, you're going to go with later. If, of course, it's 10% now or 20% later, then you're going to go with 10%. Not an issue, though, that I think you'll have to deal with in terms of any exam question. It will simply be, here is an unincorporated trade, and the trader disposes of one qualifying business asset and reinvests maybe all, but possibly just some of those proceeds. Can we then deal with the rollover relief claim and how that works? If you do make the claim, plenty of time to make it in. A claim must be made within 4 years from the end of the tax year in which the disposal occurred. So if, of course, we're dealing with a disposal in 1920 tax year, 4 years on from the 5th of April 20 is the 5th of April 24. And if, of course, we were dealing with 2021, 4 years on from the 5th of April 21 is the 5th of April 25. So as with all of these reliefs, the important issue to begin with is to recognise which relief is available. You therefore need to know the compliant conditions. We will be dealing with a trader who sells a property used within the trade and reinvests those proceeds within the relevant time period, a year before to 3 years after the disposal date, in another qualifying business asset. If we reinvest all of the proceeds and choose to make that claim, then all of the gain will be deferred. How is it deferred? By deducting that gain from the base cost of the newly acquired asset. By making the new asset's cost lower, any future disposal will have a consequentially bigger gain. If then we fail to reinvest those proceeds, then the gain will crystallise. If, of course, we sell and buy and fully reinvest, then the gain will continue to be deferred. Right. Let's have a go at a little example, therefore, whereby let's assume that we're dealing with an unincorporated trader who has sold off a property used within the trade. So land and buildings, qualifying business asset for purposes of rollover. So the sale to begin with is just a perfectly normal gains calculation. What were your net proceeds? What were your full allowable costs? What is the chargeable gain? And as you can see, I've shown you here that the net proceeds were £1 million and the full allowable costs were £600,000, giving rise to a chargeable gain of £400,000. Now, the question is, what have you then done with those proceeds? We'll look at two situations that may now arise. The first situation is that we reinvest in a new business property that has a cost of, well, this one was sold for 1 million. Let's say that the new one has a cost of 1.2 million. You would also, of course, be supplied with the date of that acquisition, as well as the date of this disposal here. And you need to ensure that the reinvestment has, of course, occurred within the relevant time period. What was that relevant time period? I hope you're saying to yourself there, a year before, up to 3 years after the disposal date. Check those dates carefully within the question. What we also see is, having sold for 1 million, we bought for 1.2 million. What does that mean? It means that full reinvestment of the proceeds equals full rollover. Full rollover means all of that chargeable gain of £400,000 would be deferred. So if we choose to make the claim, and do make the claim by the relevant date, we would now have less rollover relief, and that rollover relief would be the full £400,000, bringing us down to what would be a revised chargeable gain post this rollover relief of nil. Why do we get the relief? We've got a qualifying business asset being sold, a qualifying business asset being bought, and it's being bought within the relevant time period. Relevant, that is, to the date of disposal, year before to 3 years after. Having recognised that rollover relief is available, do we get it in full? Yes, we do, because having sold for 1 million, we've bought for 1.2 million. We have reinvested all of the proceeds. Back in the notes, we recognise here in part C that, and it is way more likely in an exam question for you, that you won't be reinvesting all of the proceeds. What you'll have at best is partial rather than full rollover. So what does it say? Where the disposal proceeds of the old asset are not fully reinvested, the surplus amount retained reduces the amount of capital gain that can be rolled over. So to the extent that you retain sale proceeds, then that amount of the gain will remain chargeable. So let's go back to our example. In that one, we had a new property cost of £1.2 million. Let's now change that, and with it the rollover and the amount that will be chargeable. Let's now change that to, now remember, we sold for 1 million. Let's assume that the new property cost is 0.9 million. 0.9. Now again, we checked qualifying business assets, reinvestment within the relevant time scale, but we haven't reinvested all of the proceeds. So what we're saying that any amount of the proceeds of £1 million that we fail to reinvest, that amount of the gain will remain chargeable. If you've got the cash available, you sold for 1 million, you were bought for only £900,000, then how much of this gain of 400 will remain chargeable? Now, I hope you can see that common sense, that's 100,000. The calculation being you'd sold for 1 million and you bought for £900,000. Therefore, you've taken out net proceeds of £100,000. You've got the cash. There is no reason why that £100,000 out of your £400,000 gain, there is no reason why that should not now be chargeable to tax. And remember, because you're only selling an asset used in the trade, you are not selling the trade. On that basis, that any amount of this gain that is remaining chargeable, assuming, as will be the case, that the taxpayer is indeed a higher rate taxpayer, then we'll be talking about a 20% tax rate. So here, sold for 1 million, bought for 900, you failed to reinvest £100,000 of those proceeds, that amount of the gain remains chargeable. Well, if 100,000 remains chargeable, that is out of a 400,000 gain, the rollover relief is just a balancing figure here. It's simply a balancing figure. So what will that be? £300,000. What do you do with that rollover? You revise the base cost of the property. Now, back when you had the original disposal and purchase, all of the gain of 400,000 was eligible for rollover. How would you have rolled it over? You would have deducted it from what was then a property cost of 1.2 million. That means that its allowable cost would have become £800,000. In that first example, where the new property cost 1.2 million, you fully reinvested all the proceeds, therefore all of the gain arising 400 was eligible for deferral. How do you defer it? You roll it over. You deduct it from the base cost of the newly acquired asset. That was 1.2 million less 400,000 would give you an allowable cost of £800,000 there. What happens now? Exactly the same principle. Your new property cost is £900,000. The rollover relief allowed is not now the full 400,000, but is just £300,000. So what will now be the deemed cost of your new property? What is the actual cost? It's £900,000 minus what is the rollover relief? It is 300 equals £600,000. Here you bought for 900,000. The rollover is 300, therefore allowable cost 600. In the original circumstance, where we had replaced with an asset that cost 1.2 million, we'd reinvested all of the proceeds, therefore the entire 400,000 gain was eligible, and if we made the claim, that would bring the allowable cost down to 800. So whether it is full rollover or now partial rollover, I have to say that this one, the partial rollover, because there's more work to do, is by far the more likely scenario for a 2-mark objective testing question. That, whether it's full or partial, you take the gain eligible for rollover relief and you deduct it from the cost of the newly acquired asset. That, therefore, in turn reduces that cost. Lower cost on a future disposal gives rise to a bigger gain, but guess what? If you reinvest all the proceeds at that future point in time, all of that gain then arising will continue to be deferred. Only when, as you see here in this second circumstance, where you take money out on the deal, you sell for $1 million, you buy for 900,000. To the extent that you've withdrawn those proceeds, you have the cash available. There is no need for HMRC to allow you then to defer the gain, and that part of the gain will remain chargeable. The balance eligible for rollover, we do as we always do. We deduct it from the base cost of the newly acquired property in establishing the allowable cost for that new property. So we should now be able to deal with any situation where we have a sale and a purchase within the relevant time scale. Again, I didn't put dates on this. An exam question will put dates on that. You have to have the reinvestment within the required time period. So what you're looking for, is it a qualifying business asset being sold? Yeah, business property. Do you have a qualifying business asset purchased? Yeah, a business property again for use within the trade. Have you reinvested all the proceeds? Yes, then all of the gain would be eligible for rollover. If you haven't reinvested all the proceeds, to the extent that you've extracted that money from the business, the amount you've failed to reinvest, that amount of the gain remains chargeable and only the balance is eligible for rollover. But for rollover relief to be available, you have to make that reinvestment within that relevant time scale. Okay, with that in mind, therefore, let's just go back to those notes and you have the chance to practice here with example 4. So have a go at example 4 and we'll have a quick chat about that before moving on. Okay, let's see what we've done here and hopefully no problems. Again, of course, make sure we've read the specific requirement of any 2-mark objective testing question, such as this may be, and it was calculate the gain to be deferred and the base cost of the new asset. So, Jones purchased a property for use in his business, property, qualifying business asset, its use in the business, back in March 2006, cost $250,000. August 2020, sold the property for $300,000. So again, a very obvious calculation. You're just going to do this in the most quick and easiest way you can. No marks for presentation on an OT question, objective testing question. But you can see that you've got sales proceeds of $300. You've got a cost of $250. You've therefore got a gain of £50,000. The question is whether all of that gain can be deferred. So what did we sell for? $300,000. What did we then buy for? Spent $320,000 in June 2020 on a new business property, a qualifying business asset, if, of course, that is then used within the trade. The timescale involved, we sold in August 2020, the purchase in June 2020. Is that within the 12 months before to the 3 years after the disposal date? Yes, it is. It is within the 12 months before the disposal date. Therefore, reinvested all the proceeds, all of the compliant conditions satisfied, therefore all of that gain will be deferred. Rollover relief of $50,000 will apply against what was the base cost of the new asset, $320,000. So the deemed cost, therefore, $320,000 minus the gain to be deferred, $50,000, will equal £270,000. Again, I'm sure you've checked through that already with the answer. If so, and you're happy with that, move on to example 5, where, well, let's see if we can recognise what is happening here. Jerome bought a factory, a qualifying business asset for use within the trade, for £680,000 back in June 2004. In August 2020, wishing to move to a more convenient location, sold the factory for £800,000. So we've got costs $680,000 and we've got proceeds $800,000. So very clearly we can see what the gain is. Moved into a rented factory until January 2021, when purchased and moved to a new factory. So in August 2020, he sold the factory, moved initially into a rented factory. Well, you've not bought, so there's no ability to roll over there until there's the acquisition date, January 21, when purchased and moved to a new factory. So January 21, it's of course after the disposal date, but it's well within the 3 years following that disposal date. So yes, we would be able to make a claim for rollover depending on how much of the proceeds we have reinvested. So remind ourselves, sold for £800,000. And on that sale, we made a gain, 800 minus 680, equal to £120,000. Assuming that all beneficial claims are made, i.e. rollover relief, calculate the base cost of the new factory if it was purchased for £750,000 or £600,000. Now, something that you see here is common to each of those particular numbers, the £750,000 and the £600,000. That is that it's less than the sale proceeds of £800,000. We have not reinvested all of the proceeds, whichever of those two we buy. So the question is whether any partial rollover would be available to you. So over to you, therefore, to work out what the base cost of the new factory will be if, firstly, we purchased it for $750,000, but then what would happen if we purchased it for $600,000. Have a go at that now, please. Okay, let's see how we fared there. Again, in terms of your method of presentation, it doesn't matter. It's an objective test in question. All that matters is that however you present, whatever you do, it leads you to the right answer. Now, what we needed to work out here, the object of the question was the base cost of the new factory. Now, to be able to work that out, we needed to know, of course, what the actual cost of the new factory was, and then, of course, what rollover relief arose on the disposal. So the first thing to do is think about it like chronologically, as it were, in terms of, okay, so we've got a disposal. What was the capital gain on the disposal of the old factory? Sold for 800, as we saw, bought for 680, as we had easily computed as we read the information in the question. We were talking about a gain of £120,000. If we had reinvested all of the proceeds of 800,000, then all of that gain would have been deferred, and therefore we'd have deducted it, the full 120, from the actual cost of the new property. The problem was the purchase cost of the new factory was only £750,000. Therefore, we sold for 800,000. We bought for 750,000. What does that mean? We have taken out 50,000 of those proceeds on this deal. We have failed to reinvest. And any amount of those proceeds we fail to reinvest, that amount of the gain would be chargeable immediately. There'd be no rollover relief in relation to it. So the balance of the gain is what remains chargeable. There's your gain rolled over. That is your rollover relief. That is a balancing figure of £70,000. 50 of the 120 gain is chargeable immediately, leaving us with the remaining 70,000 eligible for deferral. Take it away from your purchase cost of the new one, 750 less the available rollover relief of 70 equals an allowable cost of £680,000. That 50,000, as this note then goes on to say, this wasn't required for you, of course, of you in this particular question. It is just further information given, as of course is another part of this note. So just fill you in on what this narrative bit says, none of which was required to answer this question. That's the figure 680 that you needed to know to answer this question. But as 50,000 of the proceeds has not been reinvested, this amount of the gain remains chargeable. Now we know that we haven't sold the business, merely an asset used within that business, so entrepreneur's relief is not available in respect of the gain of 50,000. that is now immediately chargeable, as it is not the disposal of the business itself, but simply an asset used in that business. Now, what we've done up until now, and probably all that the exam question will do anyway, is just to do the calculations, the mechanics of it. But what we have to understand here, though this would be more relevant if you're probably dealing with advanced taxation at the professional stage rather than here, dealing with just the basic taxation UK paper, is that we have a 4-year window of opportunity in relation to making claims for rollover relief. What we've seen is there must be a single sale, the sale of a qualifying business asset, a property used in the trade that gives rise to a chargeable gain that qualifies for rollover relief. But although we call it replacement of business assets here, I said to you at the very beginning, all that matters is that we reinvest in any other qualifying business assets. Now, the only ones we're likely to see here, you remember the list, it was property, land and buildings used within the trade. There was also fixed plant and machinery. But what we're likely to find is that that has its own separate rule that we'll see just a little bit later on, so far as this area of our syllabus is concerned. So what it means is, if as here, you had sold for 800,000, but you bought for 750, then that 50,000 remained chargeable. But what could happen if within 3 years of the disposal date, remember the 4-year window runs 3 years after the disposal date, that if within that 3-year period we were to reinvest another £50,000 or more in any other qualifying business asset, we went out and we bought a further property for more than £50,000 there. If we did that, then the reinvestment has occurred within the relevant time scale, 12 months before to 3 years after the disposal date. So the reinvestment may in reality be made up of not just one purchase, as was the case here, that limited the rollover relief to just 70,000 and therefore created that chargeability of 50,000. If before the 3-year deadline has run out following that disposal, more qualifying business assets are purchased, then further claims for rollover would be available. Now again, from a planning perspective, and I say it's rather more advanced tax than it is Tax UK, unless this came up as a part of a 10-mark exercise in Section C, a written exercise for you to discuss, which is not impossible, though I think it's probably unlikely. But if that did happen, then we would always point out wherever you have partial rollover, then although we can do the number calculations as it stands, how much of the gain will remain chargeable, how much is deferred, and how that deferral, that rollover occurs, how it reduces the base cost of the newly acquired asset at that point in time. We would also be telling our client, in our responsibility here as the accountant, we would be telling our client that at this point, the amount of the gain of 120, only 70,000 was available for rollover because we'd failed to reinvest this 50,000 and therefore the 50 remained chargeable. But as we've said, if however a further £50,000 were to be reinvested in other qualifying business assets by, what is the date, 3 years from the disposal date, i.e. by August 2023, then a further rollover relief claim could be made to defer the remaining gain. That is an important practical issue and communication issue, but as I say, the only possibility of that is, were it to be part of the planning style question, the 10-mark exercise in Section C. But if you're looking at this as a background to your advanced taxation studies, it's a sort of thing that could certainly come up there. Now, what happened if you bought the factory for £600,000? Now, as we've seen, we have sold for £800,000. Remember, we had proceeds of 800. We had, there we go, let's just break that out for the moment. We had sales proceeds 800. We had cost 680, and therefore a gain of 120. But if now we bought for £600,000, then of course we are not now going to get any rollover relief at all. We haven't been able to reinvest enough of those sales proceeds of 800,000 to get any of the gain that has now arisen eligible for rollover. In this case, the amount of proceeds not reinvested is 200,000. Sold for 800, bought for 600. £200,000. That exceeds the gain made on the old factory. Thus, none of the gain is eligible to be rolled over, and so there is no adjustment to the base cost of the new factory. It remains at its actual purchase price of £600,000. Remember, of course, that in relation to that purchase, sale, entrepreneur's relief would not be available against the gain of 120. We know why. It's not the disposal of the business. It is simply a disposal of an asset used within the business. But at that point, sold for 800, bought for 600, failed to reinvest 200. How much gain arose on the sale? 120. You've taken out 200,000. You've taken out all of those proceeds, generating that gain. So none of the gain was eligible for rollover. But of course, the clock still ticks on. If, however, further reinvestment in qualifying assets within the relevant time period, i.e. by August 2023, is made, then claims for rollover may then be available. If we get those reinvestments up above 680, why 680? We'd sold for 800. If we had again reinvested at least 680, then that would mean if we go above 680, we haven't taken out all of the gain. Some of that gain will remain chargeable, but some of it will then be eligible for rollover. What will happen therefore for this to happen? Further reinvestment must be in excess of £80,000, and full rollover would be achieved if the additional reinvestment amounted to at least £200,000. You've got to get up to at least £680,000 here being reinvested. Otherwise, you've still got 120,000 gain, 800 again. Well, if we look at what we had going back here, 800 minus 680 cost, you're going to have to reinvest at least 680 to be able to get any claim for rollover whatsoever. Again, the basic answer to this question was you buy for 600, no rollover relief currently available, because you've taken out £200,000, the gain you made was only 120, therefore you don't get any rollover relief. If it was a written exercise, you'd then be able to explain to your client, though at this point there's no eligible rollover, the clock's still ticking. If in that 3-year period following disposal you make further reinvestments, at best, if you reinvested on top of the existing 600 another 200, then that would mean you'd reinvested all of the proceeds. But at least if you reinvest more than 680, some of the gain arising of 120 would then be eligible for rollover. Okay, back to your notes. Back to your notes here. And what we'll discover, and well, this lecture's gone on rather longer than I'd thought, so what we'll do, we'll take a break at this particular point in time on this one. We're going to have 2 lectures to cover all of the details of rollover rather than one, so apologies for that. A couple of areas to deal with, which I'll take you through next time. What happens if only some of a property is used within the trade, and some of it is effectively an investment asset. What does that mean? It normally means we rent out a part of the property. We don't use all of it ourselves in our trade, we rent some of it out. Now, clearly what that means is that not all of the gain would be eligible for rollover. We're only able to roll over that amount of a gain that is a gain arising on an asset used within the trade. So what happens in that? We're obviously going to restrict the amount of rollover that is available. The gain that is eligible for rollover will be restricted. And finally, what we'll deal with is reinvestment in a depreciating asset. Don't worry at this point what that means. The principles will be the same. It's just that the mechanics are slightly different. Okay, look forward therefore to seeing you for that next session, and what I promise will be a final session in relation to rollover.